We should be in business. Let's see here. There's the disclaimer. All right, I think we're live. We've got it working again. How about that?
I think we're live too. Very, very nice.
And much to Frances's joy, and she won't have to establish a GoFundMe to deal with her legal fees. We now have a disclaimer. I even have an audio version of it.
I was losing sleep over this.
There you go. Now you will.
As was I.
Now you'll sleep sound. Yeah. Me, I'm independent.
Yes.
I'm insulated.
Yeah, but we're going to throw you under the bus if anything happens.
As long as I could borrow a couple lawyers, I'm good.
Borrow lawyers. That sounds dubious. Okay.
Yeah. So, all right. Welcome everyone to a Wednesday version of the Rebel Finance Podcast. Doing it on Wednesday because I have a tea time tomorrow. Sorry. Good time to do it though. Really interesting day. In today's newsletter, I titled it "One Step Forward, Three Steps Back." Kind of talking about we've seen somewhat of a lowering of trade tensions. The market's kind of bounced a little bit. And then, coming into this morning, you have the NVIDIA news. And then throughout the day, that starts to get worse. And, you got Powell speaking, and that could always be an event. But, I don't know that anyone was really thinking it'd be that big a deal. Turned out to be a huge deal. Powell basically said, hey, no Fed put. And, too much uncertainty right now for us to lower interest rates, which is obviously what Trump's wanted him to do. So you see here, chart of the SPY. We got up to the 20-day exponential moving average, which is just a moving average I happen to watch. And kaboom, we are now slightly above the 10-day. So if you want to be bullish, you could say an undercut and rally at the 10-day moving average. Or if you want to be bearish, you can say it hit the 20-day EMA and failed. So that's kind of what's going on. I'll open it up. Jeremy or Francis, what are your thoughts?
Jeremy, you start.
I'm going to first start by saying thank you for getting a song stuck in my head. That step forward and three steps back. Yeah, Paula Abdul, that the Opposites Attract song, stuck in my head all day.
Thank you. Now it's stuck in my head.
You're welcome.
I wasn't thinking that.
I was hoping you weren't.
It's really an awful song.
It truly is.
That looks like a nice glass of wine, Matt. I'm sort of wishing I had one.
Hey, there you go. I gotta get a beer going later. It's almost 5 o'clock. It's got to be 5 o'clock somewhere. Maybe in Bermuda.
Yeah. I have a glass of wine when the market closes. So
that's a good way to wrap the mind.
Particularly after a day like today.
So if you
I made money today. Powell helped me.
I scalped some futures and made my day, so I'm happy with the NQ stuff. If you look at the chart closely enough there with SPY, right around the middle of March there, you could almost see that triple top. I mean, it was kind of warning. It was almost like you could probably make that look like Jay Powell's middle finger if you put a graphic on there. and essentially, he kind of gave it to us today. And that volatility was great. It gave us the range bar that we needed to trade in the morning, and my crew were all over that on futures. For investors, it's going to be a bit of a show trying to get into this because unless you're really savvy at selling puts when the market's down like this, you really can do nothing but just kind of sit on your hands and wait. It's really a sit and wait through it type of situation for pretty much everybody who even swing trades at this point. And there are some things that we can trade for short and midterm stuff, but the average agility of people in the market in general isn't going to be able to do that fast of a reaction to market conditions. However, you can patiently wait for opportunities, and that's kind of what we're starting to see show up.
So let's just jump into a little bit of the global macro stuff, just to sort of weigh that against what the technicals are telling us, right? So the big question out there is, are these bear market bounces on up days, or have we hit the bottom with regard to the worst case scenario with the sort of trade and tariff situation? Obviously, we went into this, okay, so very late cycle, tons of debt in the system, super valuations in the Mag 7, huge concentration, right? All of these sort of risks coming into this sort of Trump tariff adjustment. Trump was obviously counting on the fact that he has an enormous amount of leverage with the US consumer. We are a gigantic percentage of GDP. For those who, export to us and we buy their stuff. And the other piece of leverage that was missing was, the fact that we have the debtor creditor relationship with a lot of these foreign entities. And the market sell off, he was hoping would liquefy the bond market. Ray Dalio has come out with the most sentient comments on this, not surprising given his global macro spiel. And basically he's saying, like, look, guys, we've got 3 years to get our deficit to GDP spending down from between 6 and 7% to between 3 and 3.5%. Otherwise, we fly off a debt cliff. So if you take back and you reverse engineer Trump's tariff calculations, assuming all variables remaining constant, which never happens in markets, if you reverse engineer the math, Ray Dalio goes on Tucker. Tucker talks to those guys, and basically, if all of the income from those tariffs, those numbers that he picked, from all of the stuff that we purchased last year, if all of that were to remain constant, it takes that deficit spending down to about 3.5%, which would then justify major tax cuts. So that was the master plan. Also, a market sell-off, taking some air out of the bubble. You had 24-ish% 2 years in a row on the SPY, and taking some of that air out of that bubble, hopefully liquefying the bond market, which would drive interest rates lower, regardless of what Powell was doing, potentially, trigger Powell into a put, which of course today he took that off the table. That was the master plan. Unfortunately, what occurred instead was yields spiked, and also the dollar sold off. The correlations between the dollar and the SPY have broken down. The correlations between the dollar and the gold have broken down. And so there's this sort of anti-US sentiment in the marketplace right now. Obviously, the news headlines are that the Trump administration is going back and forth with a number of countries. But let's just say that even if some of the tariffs back off and we have the worst case scenario priced in on tariffs, we have difficult comparisons, maybe the hardest ever for large cap equity, particularly tech. And we have, warnings coming out from these companies on decelerating earnings. So that's going to be the next headwind for stocks. And from a technical perspective, when we're looking for momentum to the downside or support or potential, bear market rallies, it's going to be against those fundamentals. And that makes the picture look a little bit weaker. Soft data coming in, recessionary. Hard data not yet there with the labor market. That was Powell's big justification. But that hard data is probably going to follow the soft data. So far, the M2 money stock, which is usually heavily correlated with the S&P, has gone up this year. But it's probably, with the fiscal cuts coming in Doge, probably markets are anticipating that that's going to drop. So that's the contention, and that's now putting real recession risk on the table.
Right. So relief rallies indeed.
Can I ask Frances a question?
Yeah,
Yes.
go ahead.
Frances, so since we've met, I've now started following Ray Dalio, right? Not,
good.
not like I didn't follow him before, but I follow him closer. And he was the big headline about 2 or 3 weeks ago, right? He was on Meet the Press, and he said something worse than recession, quote unquote. Then he said tariffs are disruptive, not good. He kind of talked about a 1930 style depression, said the same thing you said about cutting the budget deficit, et cetera, et cetera. So I guess my question to you is, is this Doge, is Doge supposed to be doing this, cutting the deficit? And if that's the case, I mean, is the Doge slowed down? I mean, where's Elon these days? So is that still in the cards? Can you get to 3%?
I don't know, right? So let's look at the various levers, right? Obviously, tariff revenue is something that they're looking at because they don't want to raise taxes. So taxes is the other thing, revenue. Lowering interest rates, which makes the service on the debt lower and also helps the consumer and tries to, keep demand in the marketplace. So those three levers, right? That's what you got. And I'm sorry, fiscal spending as well. Fiscal spending. So basically, you have a complete catch-22, right? Because basically, we consume so much that we have tons of leverage when it comes to these tariff talks, but we are a debtor nation. And if these nations retaliate with their leverage, which is selling our bonds, selling US dollars, that's going to support the narrative that the US shouldn't have the world's reserve currency. And our debt ratios are so out of control that if we didn't have the world's reserve currency, we would look, we would have kind of a third world balance sheet. What's exacerbating this problem on the plus side, Basent came out and said that we have a bad equilibrium. About the top 10% in America are responsible for 40 to 50% of American consumption. He said that on a CNBC interview. What he's counting on is that even if the stock market sells off or something softens or tariffs come in and raise prices, he's counting on the fact that this top 10%, if they want their Ferrari, they're going to buy it. If they want their whatever, they're going to buy it. So that's kind of working towards, to his advantage in that sense, because that kind of keeps that end of the leverage working. It's just that Ray is like, look, guys, at some point, if this picture gets any worse, debt-wise and deficit-wise for the U.S., you're not going to have buyers in the bond market. You're going to have a hard time having liquidity and demand in the bond market. That's going to risk not financing our debt. And then we're looking at a different credit situation in the U.S. And basically, statistically, he was able to prove that without the U.S. dollar as the world's reserve currency, we are sort of banana republic-ish. Right. So that's the big risk on the table. So that's the global macro thing. So really what happened is I think Ray got to Tucker Carlson, did a big interview. Tucker is in communication with the administration. And they made this priority number one, because if you reverse engineer the math on his tariff math, which was nebulous at best, right? That's what you were looking at. You were looking at that deficit to GDP reduction. And it's just the math worked a little too well, right? If all those variables were constant. But unfortunately, the bond market just wasn't having it. And honestly, there are probably traders out there that were against the whole tariff situation. So those are the risks on the table, is that, you can't break the bond market. So that's where we're at narrative wise. I think it's like what Matt says, like, look, we have all the tariff narrative back and forth, back and forth, back and forth. We don't know what that's really going to end up being. However, we're going to start falling into this sort of fundamentals picture kind of around earnings and growth projections. And so, and Powell, luckily, because tariffs they didn't raise inflation actually in 2016 when he initially did his first round of tariffs, but because tariffs lend itself to inflation risk, Powell can kind of walk the line on, there's a conflict between my dual mandate. There's always a conflict, but that's another webinar. So basically, that's what we're looking at. So it's just really what determines how crazy of a bear market this is potentially is credit risk.
So let's talk some about what investors should be doing here. And I've got a lot of thoughts on this. So one of the things I think I wrote about on Monday, and I like to look at markets a lot like I look at cards, where in games like poker and blackjack, there are times the odds are in your favor. That's when you bet big. And there are times when the odds aren't. And, that's when you either bet small or you fold. And it is fairly obvious in cards when the odds are in your favor or when they're not. Same thing in markets. Right now, the odds are not in your favor. But the one wild card is at any point in time, this whole trade war could go from hot to cold very quickly, which is what we saw, what was it, Wednesday or Thursday when the market went up 10%. So something like that could happen. So what I wrote about is it's kind of like I've got a 5-7 suited and I'm going up against aces and kings. The odds aren't great. I could get a straight, I could get a flush, or I could get my ass kicked. So, to me, that's a hand you could bet small, or that's a hand you could fold. depending on your tolerance for risk, understanding one tweet from Trump and we've got an up 10% day. I do think until it gets taken out that the low is in. It's, that 480 level on SPY. I think we've got tradable patterns if you're a swing trader. Before today, there were undercut and rally moves all over the place. So I think as a swing trader, you can play this market. I think as a longer term investor, you should either be staying away because, again, the odds aren't in your favor, or you're in small. Maybe there are some names that, you want, and, if they go down a little bit more from here, fine. But, I would not be getting in big. I would not be falling for the, hey, if you loved, the stock at 200, it's even better at 100. If you're a long-term investor, doesn't matter. I mean, yes, it does. You always want to be avoiding losses. And this is a tough environment, until it isn't. I think if you're bullish, you were hanging your hat on two things. You were hanging your hat on the potential of a Fed put. And, when Weller came out and talked about that earlier in the week, I think that was big. And you're hanging on the possibility of a lessening of trade tensions. Powell just pulled one of those legs out today. So now you're sitting here hoping that either Trump, and again, if you're bullish on the market, Trump relents, or China relents, or, we get some easing of tensions here. So that those are my thoughts. And anyone else?
Matt, can I just add something? The other thing that you can potentially be hopeful for is Scott Bessent did talk about trying to shove the reconciliation bill through. We don't know exactly what it looks like. There are rumors. Obviously, Trump has talked about no tax on tips, no tax on Social Security, maybe not taxing people who make 150 or less. Those would be, if he was able to get this bill. First of all, we've got to make sure that the existing Trump tax cuts don't sunset, and then potentially further cuts. So that would be potentially bullish for the markets. He's trying to use trade revenue as a justification for tax cuts in a moment like this where we're running these super high deficits and debt. So that is one other sort of upside risk for sure.
So do you guys think Trump is like pricking the bubble intentionally? I mean, see that
Yes.
talk out there. You do.
Yeah.
That's the obvious yes. Okay.
What Trump wants is to pull the Band-Aid off quickly.
Right.
I think he realizes over he could have done business as usual, but over a 4-year term, the market's not going to be up every single year. Take the pain now, pop the bubble, bring interest rates down, and interest rates are going to be
Aren't they lower than they were like 3 or 4 months ago anyway?
What's that?
Aren't interest rates lower than they were like 5 months ago or not?
No. So what happened is something broke in the market on the 7th. And instead of, people buying our bonds like crazy, they started selling and interest rates spiked, which is most likely why Trump came out and capitulated to an extent on some of these trade tensions, because the whole idea is bring interest rates down. And if something breaks and interest rates spike, now you've got a bigger problem. Now you've got, all of the uncertainty about trade wars, and you've got, hedge funds, systematically important institutions having serious issues around treasuries. Past 3 days, yields have come down. I do think treasuries are now a play. If you're looking for places to be invested, I think treasuries are a place, longer duration treasuries are a place you can be in now. But I would be watching 10-year interest rates. If 10-year interest rates spike, that could be a game changer on a lot of different levels.
Yeah. Yeah.
I
Everything is premised on the 10-year for sure.
I've been using we had some targets on TLT that were met, and we didn't exactly go short on it, but we were taking some limited risk put spreads on it, and worked out good coming back to support. But now I don't really see a whole lot short in that market in those two ETFs, STX or TLT. But I do notice that it's just kind of like waiting right in the middle of the range where we're looking. I don't do a lot with currency or treasury stuff anyway, but I did notice that the Chinese yen is like collapsing in value. It's almost intentional. Um, the other thing that I'm kind of wondering is, for a while, it's been known that China's been buying up tons and tons of physical gold. They don't quite have what we are allegedly having in our lockers, but effectively, it's like they're late to the party because you got Trump coming out saying that we could use Bitcoin as a reserve currency. So in maintaining the dollar status for the global system of things, does this have any weight with potentially showing signs of exactly those kind of things happening with a rebound in the bond market?
So looking at areas that I think you can be in, and and there are areas I'm in personally. I have calls on TLT. The other one is gold miners. I wouldn't be buying gold miners up here. I cut a little bit of exposure today, but I would be buying dips. Like that undercut and rally around the April 7th, April 8th, that was a gift right there to get into gold miners, which I did. I missed the first move, which I kicked myself for because gold miners are something I watch a lot, and I just missed it. But I did get in on that undercut and rally. I think that was a gift. And you'll get a gift like that again at some point. I wouldn't be buying them up here. Bitcoin, similar type of trade, but you got to be more careful. It is more of a risk on asset. But I mean, Bitcoin is held up. I've been staying away. I just did actually buy some MicroStrategy or MSTU calls today.
I loaded up on shares in that last dip.
MicroStrategy. What's that?
I loaded up MSTU shares to increase my options wheel position size. I couldn't get a put order to sell, sell to open to fill, so I just said heck with it and bought shares because it was right in the zone where I wanted it more. And
yeah, I mean that's a nice looking chart.
Yeah,
still
it's right off
Matt,
the bottom.
Can I stop you guys for a second? I wanted to ask Frances a question before we move too far away from what she had talked about earlier, the macro stuff.
Yes.
I'm going to compliment you, first of all, Frances, because I went through our last video earlier today, and you made some good comments. You said tariffs are a generator of volatility. Obviously, that was the case. You said this can happen very quickly. This is obviously the case. And then you also said global macro would take over. So, yeah, it's obviously the case. So those 3 for 3, right? So that's good. So I'm going to ask you a question. You also said that we were in season 3, right? And when I look, it's funny. I feel like 6 weeks later, it's only been 6 weeks. Now, are we in season 4 already? I mean, it happened that fast. So before we moved on, now we're in season 4, which is, can you explain season 4, season 3 to season 4, please? Sorry.
Yeah. So decelerating the rate of inflation. Obviously, we haven't hit a deflationary scenario yet, but depending on how that rate of change kind of changes, you can. And then decelerating in growth dramatically. And so, yeah, we're in season 4. And as Matt makes an excellent point, look, we could come out of it very quickly, right? We were in season 4 during COVID. Maybe you guys remember, it either sold off 23% in 28 days or 28% in 23 days is what my recollection is. But it was just such a huge spike down. Fed came out and did something unprecedented, backed high yield credit, didn't buy stocks, just stopped short of buying stocks. Of course, the Bank of Japan did do that at some point, but the U.S. Federal Reserve has never done that. But things like that can happen. Obviously, Powell's not a fan today, but we can come out of season 4 very, very quickly with a Trump tweet. What Trump is going to have to do to continue to play hardball on tariffs is he's going to have to be, have some parameters in place to somehow not break the bond market. So that's the risk on the table. So another thing I want to say is credit spreads, right? High yield credit spreads have obviously gone up dramatically. But this is the scene that we have in America. We have a completely bifurcated economy. One of the things that Dahlia was the expert in, but basically the lower 50 to 60% of Americans, they don't own assets, right? So when you have this inflationary scenario, they don't have stocks and housing prices going up with their egg prices or their whatever prices, right? They just have egg prices going up. And so that bottom half of America is living on credit card debt. We have a record amount of credit card debt in the system. They hit record amounts on interest rates. So that's a lot of demand in the marketplace. And that's, I think, where there is a lot of risk. You start to see, so that's where there's a lot of credit risk. Credit risk will derail a Trump tweet in out of season 4. And so that's the thing we really got to watch. Usually when you're coming out, when you're talking about inverted yield curves as precursors to recessions, it's when the curve is re-steepening that you get the credit problems. And that's what we're seeing. Despite so all of these anomalies in the bond market, we're still seeing, that we came out of a deep inversion into a re-steepening scenario. So we just have to see if we can get through there credit-wise. If we're able to do that, I think if Trump is really able to get some massive tax cuts, basically before the election, it was like, let's change the operating basis. We have 40% of our GDP is public spending. We're drunk on public spending. That lower 60% has gotten left behind in that equation. And then 43% was small businesses, of GDP. And so he wants to take away the public spending GDP and really goose the private sector. Unfortunately, there is this disruption and the change in the operating basis. So if this disruption settles, companies can get a little bit more certain. I mean, obviously, about about earnings and guidance and all of that stuff. Then I think that, we will see a bottom. We will certainly see a bottom. The credit event is going to be the risk on the table that derails that. And so you kind of have to make these weights between systemic risk versus idiosyncratic risk that's tariff related. And Matt,
but it's even
talk about it.
It's even more complicated than that, though. Once we start seeing signs of a credit event, that's when Trump backs off, and that's when Powell steps in. So,
and that's the start of season 1. Then is it season 4?
I mean, it's
season 1. Is that how it works?
Let's go back to 2008 though, because the Fed stepped in. And Geithner stepped in, and they had these massive bailout programs coming in September of October in 2008, and it didn't bottom out until March of 9. So
right.
I think, so there are lag effects to these adjustments in monetary and fiscal policy, unless it's COVID and it's like, we're going to backstop credit. So if Powell comes out and goes, the plumbing's broken, we're going to backstop stocks.
But even then, the Fed's first move was faded. Yeah. Because I think the thing you always worry about is when the Fed steps in, what do they know that we don't?
Yeah.
So, it takes a while.
It does.
Right.
Yeah.
So
it does. And the labor market is such a lagging indicator. And that's one of the things that the Fed watches most closely when they say they're data dependent. So.
Right.
What I would also say, like, all of this stuff we're talking about now is hard. Getting
hard,
out
H-A-R-D.
What's that?
Hard, H-A-R-D. Hard.
That's how you spell hard. Yeah.
Oh, I didn't know you meant hard or hard.
Good job, though, Pat. Very nice.
I think you said heart, like heart, love emoji or whatever.
No,
I don't know.
No.
Okay.
There's nothing I can say here that's going to keep me out of trouble. I just have to.
All right.
I can spell hard because I love the volatility, but yeah.
Matt uses emojis all the time, by the way, guys.
Well, hold on. Let me make my point. So all of this stuff is hard. For the next time, if you did not get out of this market, corrections like this, bear markets like this, they give you clues. And this one, you got basically legal inside information. Trump investment consistently were telling you to get out of this market. If you ignored them and were buying the dip, buying hand over fist, don't do that the next time. I mean, COVID, same thing. I mean, once they start closing stuff, get out of the friggin' market. I mean, you get warnings with all of these things. Bad in these types of situations always turns into really bad. You've got time to do stuff. Now we're in a period where it's like, yeah, I don't know what to do. I mean, again, I'm telling you, if you are an investor, to stay away, but I could wake up to a tweet from Trump tomorrow and we could be up 10%. It's just, it's a tough situation to navigate now. Personally, from my portfolio standpoint, I don't care because I got out. So I'm not digging myself out of a hole. So, for me, it's, don't try to be a hero here. Don't turn a good situation where I'm not digging myself out of a hole, and don't create a hole for myself. But that's real easy to do. Sitting here down, 15% and trying to figure out what to do, that's tough. So that's where it gets difficult.
That's
Why
learning.
is that hard? I don't get it. Why is that so hard? You're down 15%. Cut bait before you're down, another 15.
I mean, maybe, but again, you wake up to a tweet and Trump, we're back up 10%.
Right.
Right.
How do you let go?
And Murphy's Law of Investing says whatever you do is going to be the wrong move. So if you call me up, you're like, hey, Matt, I'm down 15%. What am I going to do? What I'm going to tell you is, if you sell, the market's going to immediately go up. Right. And if you don't, it's going to keep going down. So you've got to make a decision that makes sense for you and stick with it. I would say the next time, don't get yourself into this situation. And even if you didn't heed Trump investments warning, going back to the HEAT formula, hedges. Always have hedges in place. If you've got hedges in place, at least that makes the downside a whole heck of a lot less.
That's a good point.
Right.
Like, I flipped some of my long positions into collars because of that drawdown, and that's exactly that, hedging, protecting assets at all cost. But at the same time, I also maintain liquidity, so I'm out there, generating income, scalping the futures here, like little for a few months ago we were doing like 10, 15 point swings in the NQ, and that was great. You could make a living doing that. Now we're seeing like 50 and 100 point swings in the same time span. So it's like, yeah, you can make more, but it's going to be a whole lot more risk. So, how much of that do you allocate? But that's not everybody. Not everybody's going to be able to learn price action to be able to do that. And certainly sticking around in this market, when everyone's telling you, hey man, you need to protect your assets here, learning price action the hard way is not ideal either. So
well, and also let one point, you're a short-term trader,
right,
which is an entirely different thing than an investor. And I would argue, if you're a short-term trader and you got crushed in this, either A, get better education, which we'll help you with,
or get a real
maybe
job.
you should not be a short-term trader.
right. And I can agree with all that. I mean, I do run some long-term positions as well. They're well over a year old, some of them, and I get the fact that the average trader isn't going to be a me. The average trader isn't going to be a you. It's going to be a lot of people who are working 9 to 5, who can occasionally dabble, but they're not really going to be able to do much outside of having a fund manage it. As far as agility goes, I mean, the learning and how to do that takes so much time that most people don't have the time for it. So like, if we're out here doing what we can to help people navigate the market in general, I can see where you can take the adaptation or interpret that in your own way and make your own progress in the market. But when we're sitting here idling, we're saying, hey, this is probably something you don't want to get messed up in. And we've been saying that for, gosh, about almost a whole quarter now, maybe a little over a quarter. It gets difficult for the people who tend to get a little too anxious in this type of thing as well. I mean, anxiety is going to be a huge killer of portfolios too. That whole fear thing. So in a sense, it's there's not many safe havens out there. I mean, sure, you can swing in the gold mines and gold itself and kind of hedge it a little bit, but how does the average investor or the average person who dabbles in trading deal with that?
Can I pop in here?
Sure.
Yep.
So here's the thing. If you are attempting to become a short-term trader, obviously you know when you think about risk options, buying puts and calls, you are going to lose the cost of the option. That's it. Clearly, that's not the case with other with selling puts and calls. But if you're buying puts and calls, you can limit your risk. You can practice with little amounts. You can go to cash. You can trade options short term. The intraday volatility is so insane that people are going to get whipsawed like crazy. That said, from a portfolio perspective, I think this is a long conversation that Matt and I have been having for a while, which is, and you wrote something great about it, Matt, that the 60-40 portfolio is broken. When you've got the
Yes.
bond market, the stock market, and the dollar selling off simultaneously in this larger Ray Dalio cycle of is the U.S. going to remain the U.S. as we know it? That's a really tough, that's a tough conversation with, buy and hold, blah, blah, blah. So we're looking at, potentially creating portfolios that have an options like approach to maximizing downside risk. And that I think is going to be a disruptor because basically when you look, I had a conversation today, right, with a platform provider. They have every brand name portfolio that you can imagine on their platform. And I said, listen, I just want to say, is there any standout here between all of these brand names or the biggest household names with their portfolio allocations, their vanilla portfolios, et cetera? He said, not really. There's just no standout, right? Because again, they are all still from a equity fixed income ratio adjustment type mentality that we've all been stuck in for decades. And with that conversation about Dalio saying like the dynamics of the US financial markets could potentially change, that's the thing is Matt and Jeremy, you guys are not getting killed because you've got a large cash position, you've got a large position in things like treasuries, and you're trading a lesser percentage. You know how to trade, you know how to do volatility. And so I think we have an opportunity to continue this conversation to bring this thought process and bring the H.E.A.T formula into portfolio management. And then because the rest of the portfolio management world's just a race to the bottom on fees, and people are just being told with their retirement, just like stay the course when these massive winds are changing and we've got the baby boomers are in retirement, etc. So I think that's an interesting thing. So I like to think about option like volatility. So for those that got out of the market, but you might want to think about pairing some of your positions and pairing some of your risk, and then looking at trading options and just sticking to buying puts and calls initially, just so that you can control the amount that you're losing. I'm always an advocate of trading very small amounts or trading paper accounts for anybody who's trying to learn how to think with these long-term charts in an environment that according to Dalio, we haven't seen in 80 years. And of course, in an environment where the Trump dynamic is unusual.
So couple of things there. The 60-40 portfolio was funny. I normally don't have CNBC on, but with everything that's going on, just, trying to keep track of the news, I had it on in the background today. And I heard someone say, oh, the 60-40 portfolio wasn't built for situations like this. Like, what? It's supposed to be exactly built for situations like this. The idea is it's supposed to protect you when the market goes down because your bonds are going to go up. And, I found that funny, especially on CNBC. But yeah, I mean, it doesn't work. It's never worked. It appears to work because most of the time the market is going up. And since 1981, interest rates have been coming down. So it appears to work in that situation. But, just go to, this past month, failed miserably. 2022 failed miserably. It does not work. And the problem that you've now got in the asset management, wealth management industry is when the 60-40 doesn't work, traditional asset allocation up until this year, anything other than US large cap growth hurt your portfolio. When that doesn't work, then the wealth management industry, the asset management industry, the CNBCs of the world have nothing. And, as an investor out there, you're like, what the heck am I supposed to do now when all of this stuff I was told don't work? And again, that's what we're trying to do. That's what we're trying to do with the Heat Formula newsletter, trying to do with these podcasts, setting up a wealth management firm, because just what's out there is just not good enough. I think the world really needs that more than ever.
Can I jump on this, please? Because I have had some. I actually wrote all this down. I spent like all day writing this stuff down, by the way. So
I got some when you're done.
So 6 weeks ago, we all were on here, right? I want to recap some of the stuff we talked about. It's going to take 4 minutes, and I'll start the rest of the time. All right,
you're good.
Matt was bearish on the SPY at 572. He said it's breaking the moving average. There's no upside. Obviously, this SPY got ripped. So he's 1 for 1 so far. Way to go, Matt. All right.
Let's go.
All right. So then we said Salesforce, 255 bullish, undercut rally, stop 232. I think Salesforce is hung up in there. I don't know. I'm not really sure, but I think that's a break even, maybe a little better, but it didn't kill you for sure. Right.
It played the range and went bearish.
So then you kept saying always have shorts. You started to talk about ratio spreads. That made me sound like a moron, but maybe we can talk about what that is. I don't even know what that is. And then remember the famous dumpster fire, Francis, right? Where Matt said, yeah, so-and-so's in the dumpster fire. So he was shorting ARC, which went from 54 to 40. So he's like 3 for 3, which is like insane, right?
Yep.
And then he said, go long the VIX, which was at 24, went to 31. So he's like 5 for 5. I can't count that high. And then we were kind of quasi-negative on Hood, H-E-A.T, and that went from like 42 to 34 roughly. So I mean, I'm just saying this is probably like the kiss of death, right? Having said that, I got to hand it to Matt.
Yay.
Right?
How has it been 6 weeks already? Since,
I know, right?
Like, where does it, anyway, I can't believe
let me say one more thing, then I'll be quiet. So McDonald's meal, I went to McDonald's again today. All right. If you remember last time that the McDonald's egg McMuffin meal was $9.99. What was it today? Any thoughts?
Oh, did it stay the same?
Same. And eggs, by the way, went from like 9 to 6.
Yeah.
Which, if you kind of did the math, that means that the margin on an egg McMuffin meal may have gone up by 2.5% with the lower egg prices.
Check
out.
That means, but, check out CALM, #1 U.S. egg producer at least on the East Coast. So that spike there when they started making more margin. Exactly your point. The chicken started maturing because they had to kill a bunch of them off in December. Your production's meeting demand, so the prices of eggs are coming down, but the margin's still there. So the prices coming down on eggs is going to obviously lag a little bit. So they made a little money in the short term.
It's interesting. Actually, you saw that.
It's my mayonnaise index. In response to a little bit about options, we've noticed in the options market, like the index options, SPY, QQQ, the main stuff, kind of blown out on price, a little overpriced. Implied volatility is through the roof, not really through the roof, but higher than usual. The time decay has been killer. So like index options, spreads will probably be your best bet. Revisiting for equities, actually it's a great time to trade equities options. So if you're looking at specific equities and you find a good trade setup, that's where your alpha is. SPY and Q not so much, unless I wouldn't be sell to open on there. The yield's not good enough for me, but you get the idea. If you're an options seller, you're loving this. If you're an options trader, equities are your thing. And then there's this
So
index.
let me jump in on that option selling thing. So one of the things, and I mentioned this at some point, that I've been doing more
Ratio
than I
spreads.
typically do is selling cash secured puts.
Absolutely.
And again, I will reiterate, A, if you're going to do that, know what you're doing, and B, make sure you have the cash in case you put the stock.
Yep.
But the cool thing about cash secured puts is you're taking advantage of a high volatility. And it also, this is an environment where, yeah, stocks could rip, but they could also, go sideways for quite a while. And so I love buying calls. So when Frances said, buy calls and puts, that is the A in the H.E.A.T formula, asymmetry.
Yep.
Because options are a heads, I can win a lot, tails, I lose a little type of thing. Selling puts is not asymmetrical returns, but there are times when it does make a lot of sense. And, you just, you put your strike somewhere where the stock is unlikely to go. So I'm not selling on Cal-Maine Foods, but if I were, kind of look at a weekly chart and see, all right, the low was 79.55. Maybe I'd try to sell a 75 put. Again, I'm not doing it. I'm just this chart happens to be up. But if I were selling a put on this, maybe I'd do a 75. And, that way, the only way I lose if the stock goes below 75. Now, if I thought Cal-Maine was going to rip, then you know what? I'd bite the bullet and pay the higher implied vol for the calls. But, in this market, again, we could go sideways to downish for quite some time. I like having a mix of cash secured puts and outright calls in my portfolio right now.
Yeah, and if you're trying this at home, which I'm advocating against,
learn it first. Learn a lot first.
Just start small.
Yes.
Start small.
Matt, what's a
really
ratio
small.
spread? What's a ratio spread, please?
A ratio spread is where you sell a call and then buy two higher price calls. And basically the idea is either you're going to have no premium outlay or you might even put money in your pocket. And what I like about ratio spreads is if you're wrong, you don't lose any money. Yep. So if I did, let's say I were to do a ratio spread on the SPY, let's change it to a daily. And again, don't do this at home.
Yes, this is an example only.
SPY's at
You can't lose. You don't lose money if you're wrong. Don't do it at home.
We want to make sure that we don't have to start a GoFundMe for Frances's legal fees.
Right. But in this example, let's say I would sell a 525 call and I'd buy two 530s. And now I need a bigger move to make money. I need it to go, above, let's say 532, 533, somewhere above that. But if it closes below 525, I don't lose any money.
So, I'm going to ask just a philosophical question for Frances and Matt, right? So let's say you go to the doctor and you have something really horribly wrong with you. And the doctor says, oh, well, I just did this, but you can't do it, right? So if Matt's the smartest dude in the world, we've just shown that because he's 5 for 5 in the worst market environment ever. Why would you not follow him down the path and do this, even though Frances says, oh, don't do this at home? I mean, why would you not do what the smart guy's doing? You know what I mean?
Right.
Connor?
Because it's something if I'm just buying a call, that's hard to mess up. Right. I put $1,000 into a call. My maximum loss is $1,000.
Right.
Once I start selling options, I open myself up to unlimited risk. And unless I know what I'm doing, I don't want to open myself up to unlimited risk. And then, there are things that can happen, prematurely. I sell an option and me as an institutional guy, I can use flex options, which can't get assigned early. But individuals can't do that. you're buying regular listed or selling regular listed options, you could get exercised early. You can wake up to a long stock position or a short stock position. And again, you've got to know how to handle something like that in your portfolio. That can be a scary thing if you don't know how to handle it. And I've woken up to, oh wow, I got a sign. All right, not a big deal. I planned for this. I've got another option on the top. I'm going to exercise that option and get rid of it, or maybe I'll play with that position. But anytime you're opening yourself up to unlimited risk, you need to know what you're doing. Futures is another example. If you don't know what you're doing, don't trade futures.
Absolutely.
I mean,
But isn't
my
it a little
mother-in-law came to me once, a few years ago. I got something in the mail that I can make money trading futures. I'm like, rip it up.
Yep, burn it.
All right, but wait, just my last point though. Isn't it a bit presumptuous though to think, like, I'm not like you because you're really like super smart. I'm just a regular smart guy, right? So isn't it a bit presumptuous to think I can't figure this out myself? I mean, if
No. I'm saying don't do it unless you figure it out yourself.
Right.
I mean, educate yourself. What Frances said is start small.
Right. Okay.
And what I say is,
fair
like, learn a little bit about it. Start small, of course, and know what the difference is between defined risk and infinite risk. Never trade naked.
And use ChatGPT.
Yeah.
I mean, again, I'm
it's a
the
gold mine
put
for that.
stuff into ChatGPT guy. Hey, ChatGPT, I want to do this strategy. And some cool stuff you can do with Chat is all right, this is what I want to do. Rate my strategy 1 to 10. Let's say it comes out, hey, Pat, your strategy's a 5. All right, well, why is it a 5? Well, because of this, this, and this. All right, well, how can I make it a 9?
What if it comes back and says this is a 0? What do you do then?
I mean, if it's a 0, you don't want to do that strategy. ChatGPT is telling you something.
Gotcha.
But I'll use ChatGPT that way. Hey, I'm thinking like my no bleed tail risk ETF I'm designing. I started off with ChatGPT, said, this is what I want to do. It gives me some stuff. All right, rate it. All right, I rated a 5. All right, let's get this up. What about this? What about this? And I got it to a 10. And that's a strategy I've now been using in my own portfolio. And that's why I made money today, because my no bleed tail risk strategy was up 14%.
Whoa, nice.
Right.
I noticed you switched from the wine to the Saratoga water, though.
Gotta
While
hydrate.
I'll get wine I'll get more wine when we're done.
That's the Russian water I'm drinking.
You know what's funny? I actually quit drinking, but when I met Matt in New York City last September, I was so starving from whatever event I ran to and was late to see Matt. I'm like, what do you got? He's like, Corona. I'm like, okay. Blood sugar, what's a girl gonna do? Managing risk here.
I made fajitas for dinner. I had to have a Corona.
Yeah.
All right.
That's good.
So Frances Stacy, why don't you close us out with some words of wisdom here now? I mean,
oh dear.
Now we put you on the spot.
I hope my comments today age as well as the ones I made 6 weeks ago. I need to be in an uptrend. I don't want to be correlated with this nonsense. No. Closing us out, first of all, we are working on portfolios for longer term investors with options like risk. We will keep you posted on that. I have to go visit Matt, so he can stock wine in Saratoga. We can talk about this, but anyway, so we're working on that. If you're going to start trading options, definitely these guys are amazing. Start super, super small, even a paper account. You learn more from small accounts than paper accounts because the psychological thing is very different. What we're watching for is we're watching for credit spreads, anything in the credit market. We're continuing to watch bond volatility, and we're continuing to watch Trump tweets around trade abatements from certain countries, tariff abatement, I'm sorry. And then Scott Bessent said 4 to 6 weeks, watch for those announcements around tax cuts. And that's my wisdom.
All right. What I would say is a few things. The odds are not in your favor here. And again, I mean, anything can happen. You could wake up to a Trump tweet. We're up 10%. You could wake up to China's raised tariffs on all of our stuff to 500%. We're down 10%. It is not a market for the faint of heart. Be careful. You can play it. I mean, we've got tradable chart patterns now. Just
nice.
Be careful out there. Watch rates. If rates start spiking, something is broken. I would tell people, I mean, if you like this content, subscribe to my newsletter. It's theheatformula.beehive, and Beehive is BEEHIIV.com. Like and subscribe to our podcast. Give us comments on how we can help. What we want to do is we want to be an alternative to the financial news, because the financial news sucks. And, you're not going to learn anything watching CNBC. They're going to have a bunch of buy and hold people on. Again, look at the advertisers. They want you to be buying and holding, which, I mean, sometimes that's fine, but that's not always fine. We want to be an alternative. Give us your commentary. Let us know what you want to see, how we can help.
Yeah.
Agreed. And my words of wisdom would be, definitely be nimble in this market. Certainly don't waste the opportunity to learn something from it, though. And that's the beauty of paper trading, to learn a process. Even if you're getting beat up in your real portfolio, you can go and play with some things in paper. And you can kind of back test things that may work or may not work. Certainly study them. ChatGTP and Grok are both really great at defining all the different risks in different strategies, especially with options. And if waking up to a Trump tweet is something that makes your hair stand up or makes you lose sleep, if you imagine if you're trading naked, like selling uncovered calls, you can wake up to a margin call. That's way, way worse. So make sure you're
That's
messing with
not
paper.
allowed.
Yeah, don't do that.
Says no.
Do not do a margin call.
Definitely not allowed.
Another quick point is we have to differentiate what are bear market rallies and what are transitions into a season one. That's the thing. We should do a seasons podcast. You guys should have me on more often than 6 weeks.
I agree.
The invite is always open. I mean,
Can
we'll have you on every week. The comments we got the last time are get rid of that Pat, Matt, and Jeremy guy and just have Francis.
Yes, you test better than we do.
Yeah, you definitely tested better than we do.
No,
Right.
but I'm in awe of your talent as traders, because I was a trader back in the day and then moved into wealth management, and so I'm in awe of your talent as traders. So I think it's a good mix. They're different religions, and we're trying to kind of create a hybrid approach because of the broken 60-40. So
it's a different game now. I mean, when you were a trader, you get like maybe 2 and 3 point moves in the ES, maybe. Now we're getting like 50, 100 point moves, and
but it's always going to be a different game,
right?
It's always going to be a different game.
There are certain behavioral aspects that will never change, but market structure changes, which brings up something we could do a podcast about. Just because something worked in the past doesn't mean it's going to work in the future.
Exactly. And it's not just an evolving market. It's also dynamically, how do we say this? Diverse. You got people realizing that more than 50% of the equity moving is in dark pool. That kind of is a tinfoil hat approach to looking at it, but it doesn't change things dynamically, because you still have price action, you still have movement in the market. Obviously, with volatility, it's even better. So spend less time worrying and more time, being able to just calmly examine things and learn from this before you do anything. Learn from it, because there's a whole lot of opportunity that's coming down the pipe here. When this does finally hit the bottom, we start to see things turn around. You're going to wish you did. That's all I can say.
Yeah, absolutely.
Well, I think, unless Patrick's got something to say, we're going to leave it on Pat.
All right, what do you got, Pat?
At some point, we got to go through the seasons, like each one of them. That's.
I'm zipping my mouth for the first time ever.
Oh no.
No, I'm good. Thank you, guys. I'm good. No, everything you covered everything I wanted to cover, so I appreciate it. Thank you.
All right. So remember, subscribe to the newsletter, like and subscribe to our YouTube channel, and let us know how we can help.
And
All right.
thank you very much for the likes we have already gotten. That really, really helps us out. Thank you so much. Everyone have a wonderful day. I'm going to wrap it up. And we're off.